Most people think markets move after the Fed makes a decision, a rate hike happens, and then markets react. But in reality, markets usually move long before the Fed does anything. That is because markets are not reacting to what just happened. They are reacting to what they believe is about to happen. The real driver is expectations. Every investor, trader, and institution is constantly trying to answer one question: what will the Fed do next? Because if you can anticipate that, you can anticipate where markets are going. This is where pricing comes in. Markets are always adjusting prices based on expected future conditions. Interest rates, liquidity, inflation, growth, all of it gets priced ahead of time. By the time the Fed actually makes a decision, a large part of that move has already been reflected in markets. The event itself is often just confirmation. This is why markets sometimes fall on good news. If everyone already expected something positive, that expectation is already priced in. There is no new information to push prices higher. And the same works in reverse. Markets can rise on bad news if the outcome is not as bad as expected, because expectations were worse than reality. So what really matters is not the data itself, but how it compares to expectations. A number is only meaningful relative to what the market was already pricing in. This is the concept of the reaction function. Markets are not just reacting to the Fed. They are reacting to how the Fed is likely to react to incoming data. For example, inflation data does not move markets directly. It moves markets based on what it implies about future rate decisions and liquidity conditions. This creates a chain reaction. Data influences expectations. Expectations influence pricing. And pricing moves markets before the Fed even acts. That is why timing matters. If you wait for the Fed's official decision, you are often too late. The move has already happened. If you want to understand markets, you need to think ahead. Not about what the Fed just did, but what it is likely to do next. Markets do not wait for the Fed. They front-run it. They price the future before it becomes reality. But this leads to another question. If markets are constantly pricing expectations, what causes those expectations to change? In the next video, we break down exactly that. The Fed pivot, and how shifts in expectations trigger some of the biggest moves in markets.